you've got a situation we're talking about using your home equity as an asset class to kind of tap and use for retirement. I mean, what are we doing here? I've got some ideas around this, but I would love to hear from you kind of what your strategy is and your thought process.
Well, like I said, during the accumulation phase, as I was, building wealth, and and I had a house. The house would appreciate, and then I would refinance, and I would keep it leveraged, not crazy way, but such that the home appreciation, the appreciation on a, let's say, $1 million house with a $600,000 mortgage, even the interest cost on the $600,000 mortgage is going to be more than offset by a pretty modest appreciation on the full value of the home. So that's during the accumulation phase. And now I don't need to pull money out of my home, but for many of my clients and many of the advisors that I speak to, who have clients who need to use both their home and or the equity that they built up in their home, and in many cases it's fully paid off, but they don't have enough in their 401k to live on for the rest of their life. Then you can again borrow against that home. Now you can, and there are prudent ways and there are not so prudent ways to do that. But one of the best ways is what's called a HECM, or a home equity conversion mortgage, which is a form of reverse mortgage, which has had a little bit of a taint to it. But that was because back in the early 2000s, and then up to the financial crisis in 2008, a fair amount of people lost money on their equity, and the government, which backstops these reverse mortgages, also, paid out an awful lot of claims during the 2008-2009 crisis. But that business has been cleaned up substantially, and now, the government will guarantee a reverse mortgage, basically up to, I think, $1.2 million is the current limit on what you can access in terms of a reverse mortgage, and you can maybe we'll get into it a little bit later, but these new modern reverse mortgages are really wonderful vehicles, because you set up a credit line when you're at least age 62 or older, and then you just don't have to draw down on that until and unless you need it. And meanwhile, that credit line will grow. And again, you're only borrowing against maybe 40 or 50% of the equity in your home, or setting up that credit line. And as that credit line grows, so does your ability to draw down and use it for retirement income. And the government guarantees that you will never owe more than the home is worth, and your heirs will never owe more than the home is worth.
Which I think is important, because in essence, if mom and dad are, and this is I'm just thinking about how I would use this, right? Because let's say we got $500,000 in a 401k between a husband and wife team. We got a home worth $1 million. I like what you're saying is go ahead and establish it now, because it grows over time, right? In the old days, the reverse mortgages, you couldn't do that because, the older you got, the better the reverse mortgage looked.
Right.
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 And so now you take that $500,000, they live on that as long as they can. And then we have to tap the home equity, in the form of a reverse mortgage. Then we do that as late in life as possible. But with the HECM, you're talking about doing that as soon as we possibly can.
Well, not exactly. Okay. Not as soon as possible. And that's where the research that Barry Sachs and I have done comes into play, because one of the risks in retirement, I mean, we talked about longevity, and that's a big one. You just don't know how long you're going to need income for. But another very big one, I'm sure you've seen it in your business, is sequence of return risk. Because, let's say and it doesn't matter so much when you're accumulating money, whether the stock market goes up 20% this year and then down 10% next year and then up 20 the next year and then down 10. You're still averaging a 10% return over the long time, and it's going to accumulate to a big number. But once you start drawing out of that pot, then the returns matter a lot. And if you're unlucky enough to have a big downdraft in the market right after you retire, and you're drawing down, you're just doubling down on a down market, and you could really run out of money quickly. So what we discovered, what Barry and I have been working on, is to use a reverse mortgage credit line almost like a buffer asset. In other words, when the market goes up, draw from your 401k. But when the market is down, don't draw from your 401k. Leave the money in the 401k to let it recover, but draw from your reverse mortgage credit line. And so and that's what we call the coordinated strategy. So if you coordinate how you draw from your reverse mortgage with how you draw from your portfolio, you can mitigate, and we've shown it in our research, almost entirely, you can eliminate sequence of return risk as a material risk in retirement.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.